Hi, my name is Karina, and I'm a financial advisor on behalf of Bingo Financial Inc. Myself and 5 other colleagues will present to you a portfolio analysis of 4 stocks: Netflix, Tesla, Coca-Cola, and Bank of America.
Hi, my name is Jennifer. So we'll be targeting 2 types of clients, risk-averse and risk-seeking investors. Our portfolio includes 2 value stocks, which would be Coca-Cola and Bank of America Corporation, and 2 growth stocks, Tesla and Netflix. And now I'll be talking about Netflix. Netflix is the world's largest provider of streaming movies and TV series, competing in the streaming media industry. It is currently in its growth stage and has rapidly expanded internationally in 190 countries. The 3 key financial ratios are operating margin, return on equity, and debt-to-equity ratio. Netflix has a low operating margin as they cannot control the price they have to pay for streaming rights. They, however, do consistently perform better than the industry average. The ratio decreased dramatically in 2015 from 2014, from 7.31% to 3.66%. It has begun producing its own shows, which would hopefully spread its costs and increase users, which would increase operating margin. The return on equity has also decreased by a large amount from 2014. The ratio has been fluctuating over the past 3 years. The low return on equity can be linked back to the low operating margin. However, Netflix can look towards increasing sales growth instead, which is possible through more international expansion. Netflix has a higher debt-to-equity ratio than the industry average. This is because they need to look towards debt for financing because of low cash flow from operations. However, as long as there is no defaults, a high ratio should not be a concern for potential investors.
Hi, my name is Changhan Park, and I will be talking about Tesla. Tesla is in automobile industry with high performance and fully electric vehicles. Since it is considered as a high-risk investment, a high reward is expected to compensate for the risk. Gross margin, operating margin, and inventory turnover ratios are important financial ratios for such innovative company. Tesla is in a growth stage of life cycle, highly volatile, negative ratios at times. With an original initial public offerings of $17 in 2010 and once the most shorted stock on Nasdaq, Tesla has gained more than 1,000% since its initial public offerings. Over 3 years, Tesla has been generating consistent growth in gross margin and becoming highly efficient due to increasing volume of productions. Fluctuations in ratios could be attributed to company being in growth stage. Continuous negative operating margin has been experienced, and inventory turnover is decreasing and less than the industry average.
Hi, I'm Mayuri, and I'm going to be talking about the Coca-Cola Company. The Coca-Cola Company is a traditional American multinational beverage corporation, best known for its flagship product, Coca-Cola, invented in 1886. The Coca-Cola Company stock is a value-based fixed income asset, and the trend over the 3 years in Co shows that this is a good investment for an investor looking for a fixed income asset as dividends increase significantly over the 3 years. The increasing dividend payout ratio signifies the percentage of earnings paid out to shareholders, and it shows that investors view the stock as a value-based stock since they expect dividends as a continuous source of income each year. The price-to-book ratio has also increased in the last 2 years, and the actual value of the ratio seems to be lower in value, which may signify that the stock itself is undervalued. In comparison to its primary competitor, Coca-Cola scores better than PepsiCo in liquidity analysis, but PepsiCo has better efficiency and growth ratios. Another important point to notice is that the price-to-book ratio for Co is under the industry average of 7.7. and this shows decreasing efficiency. Moving on to the inventory turnover ratio. This is an important ratio as Coca-Cola's success depends on its inventory and how fast its inventory is sold in the fiscal year. However, the inventory turnover is slightly lower than the competitor Pepsi, shows decreased efficiency as well. Now looking at the frequency distribution, majority of the daily returns were concentrated in the middle, resembling similar to a normal distribution, and the returns seem to be between 1 and -1, signifying minimal risk because this means the normal returns don't fluctuate or deviate from the norm. This again shows prospects of a value-based asset rather than a growth-based asset. Comparing Coca-Cola to the risk-free model with a positive Sharpe ratio, it shows the return earned solely from Coca-Cola is less than the guaranteed risk-free rate. Positive covariance shows both assets move together, but the low value of covariance shows that the investor can earn diversified earnings. A positive correlation with a low value of 0.044, which is closer to 0, means that both the stocks are moving in random directions to each other. This is reflected in the result of Coca-Cola returns being less than the guaranteed risk-free return, with the optimal positive Sharpe ratio. So in summary, investing in Coca-Cola is only attractive for investors looking for a high dividend yield and low risk.
Hi, my name is Molly. I'm going to talk about Bank of America Corporation. The Bank of America Corporation is an American multinational banking and financial service corporation currently ranked as the second largest company in financial industry. Regarding the low interest rate, it has always been considered as a mean for a safe investment. Now we're mainly talking about three financial ratios. The first one will be net interest margin. The ratio indicated how successful a BAC's investment decisions. Since BAC's ratio is below the market but showing increasing trend, this value will show an explosive increase when combined with the increase in interest rate. The second one would be non-performing loans to total loans. BAC's ratio has been decreasing every year since 2010 due to its decreased default risk on loans. Since market average is 1.77%, BAC's future value increase can be expected. The last one would be return on asset. Compared to the market, where ROA was 0.5% in 2013, BAC's ratio of 0.18% in 2014 is significantly lower due to the low federal interest rate and BAC's poor execution of strategies. However, BAC's ROA was 0.68% in 2015. And this could be a sign that BAC's situation is turning around.
Our analysis of Coca-Cola, Bank of America, Tesla, and Netflix has shown that overall, each stock is performing well in the market compared to the S&P 500. After analyzing a portfolio of the 4 risky assets plus a riskless asset, we generated 2 potential portfolios geared towards different clients. In the case of a more risk-seeking client, we would suggest to invest 45.98% in Tesla and 54.02% in Netflix, generating a high 0.33% average daily return with a daily volatility of 2.65%. Our risk-averse clients are prompted to consider investing in a more balanced portfolio consisting of 26.7% in the risk-free asset, 14.75% in Tesla, 27.31% in Coca-Cola, 26.19% in Bank of America, and finally 5.05% in Netflix, resulting in a modest daily return of 0.1% and a more conservative daily volatility of 0.87%. My name is Philip Marinovich, and on behalf of Bingo Financial, we would like to thank you for listening.